Hello friends, welcome to the unit number 13 of ABFM theory portion, and we are going to discuss the chapter name is corporate valuation. So basically in this chapter we are going to touch the following topics. First of all, we will see the introduction, we will see the approach to corporate valuation, adjusted book value approach, stock and debt approach, direct comparison approach, discounted cash flow approach, and step involved in valuation using DCF approach. So in this particular lecture we are going to cover till stock and debt approach, that means 13.1, 2, 3 and 4, right? So let's get started with our first topic, with our first point, which is regarding the introduction to the corporate valuation. So let's get started, understand each and every point regarding it. So friends, ever wondered how companies are valued? Why do one company sell for million while others struggle to find buyer? Today we are breaking down corporate valuation in simplest way possible, so that when you are new to the finance, right, you will get it in one go. Let's dive into. So corporate valuation is all about figuring out how many a company is worth. So let me write down the key point. It simply means how many a company is worth. That is, what is the worth of a company, right? So it's not just a single number, but here is the catch. It is not just one single number. There are different way to look at company value. Let's break them down. The first way to look at is book value. You know what is book value? This is like checking a company financial report card, right? You check the company financial report card, right? So it tells you the company worth based on what is written in the balance sheet. It tells you that this is the worth of the company looking at the balance sheet. So it is nothing but, book value is nothing but asset minus liability. Asset minus liability. But does it always reflect the real world value? No, it does not always reflect the real world value, right? So asset minus liability, you say that this is the book value. Now the second kind of value we have is called market value. What is market value? Imagine a company is like a share in the stock market. Its market value depends on what investors are willing to pay for it. Means what, let me write down, what investor are willing to pay, right? What investors are willing to pay for it is called it market value. So the simple formula is total shares multiplied by share price, that means per share price. So this multiplication will give the market value, right? So this value keeps changing based on demand and supply. So these are the two valuation method, book value and market value. Then there is something called enterprise value, which we call EV. Here you can see enterprise value. What is enterprise value? See, now this is the real deal. EV consider not only just the stock value, but also the company debt and liability. So stock is already considered, we have seen in market value, plus it also look at the debt, company debt, and also it look at the company liability. What are the liabilities of the company, right? So it tells you the total price someone would have to pay if they wanted to buy the whole company, debts and all, right? Someone, how much they have to pay if they want to buy the company, total company worth including debt and liabilities. So why does this matter? Because enterprise value is like looking at a house total cost including its mortgage, right? It gives a much clear picture of what the company is actually worth. That is why financial experts use it to make big investment decision. So what we have learned, book value, asset minus liability. Market value means total number of shares multiplied by share price. Enterprise value, stock price plus debt and liabilities, everything, right? So now let's look at the formula of enterprise value. So equity value plus short term debt plus long term debt plus current position of long term debt, capital lease obligation, preferred security, non-controlling interest, other non-operating liability, minus cash and cash equivalent. So this has to be subtracted, right? So basically this is an asset, right? That's why it is subtracted. So importance of enterprise value. So I think here we are. Okay, so friends, that that it approximates the worth of entity running asset, and effective finance management aim to optimize value creation for shareholder, and manager must understand value factor and quantify them to enhance shareholder value. So let's talk about the key points in valuation. So friends, first of all, let's talk about that why valuation matters in today's business world, right? So why do some company get acquired for billion while others struggle to stay afloat? What is the reason behind it? So that what makes investor pour money into one company but ignore other? The answer lies in the valuation. The answer to all this question is simple, that is valuation, right? So and today we are decoding why valuation is the most important ever in the business world. So why valuation matters most today? Because the world is changing fast. with globalization and economic liberalization, business are expanding beyond borders, and the capital market is playing bigger role than ever, right? Capital market is playing bigger role than ever. But what does this mean? Let's break it down. That because of the globalization and economic liberalization, business are expanding beyond border. And now we have talked about what is the relevance of valuation in today's business world, right? Because that first of all, that there is something called merger and acquisition boom. You see this word written here, merger and acquisition boom. Big company are either buying a smaller one or joining force to stay ahead of the competition. And guess what? They need to know the right price before making a move. Right, big companies are either buying a smaller one or joining force to stay ahead of the competition. Then we have something called strategic alliance and ESOP. You know about ESOP? ESOP is employee stock option, right? Which means more companies are forming partnership and offering employee stock option to retain top talents. But how do they decide the stock value? Again, it all comes down to valuation. So I am telling you what is the importance of valuation. For merger and acquisition, they need to know the value of the company. For undertaking this ESOP option, they need to decide the stock value. For regulatory challenge, regulatory challenge, right? So regulatory challenge means government and financial regulator also struggle with pricing, things like utility tariff, taxation policy. So valuation help them set fair prices. So at its core, valuation is all about knowing the true worth of the company. So valuation is all about knowing the true worth, right? It is all about knowing the true worth of a company, right? So in today's market, it's not just about number, it is about understanding how much a business is actually worth, whether for investment, merger or regulatory decision, right? It's not just about it's not just for about number, rather it is about understanding how much a business is actually worth today, whether for investment, whether for merger or whether for regulatory decision. So mastering this concept is key to cracking your CAIIB examination, right? So you can enroll in our videos course, which is completely in English as well as Hindi, for more such insights. Now let's talk about some primary objective of valuation is to estimation of the company true worth. Now let's talk about some basic definition. First definition is the fair market value. So friends, imagine you are buying a second hand car. You check the price, compare it with similar car and agree on a fair deal with the seller. That is exactly how companies are valued too. But what does fair market value means? And how do international standards ensure accuracy? Let's break it down in the simplest way possible. So in simple word, we can say this FMV or fair market value is nothing but the true price tag. This is nothing but the true price tag, right? So when I say fair market value, what it means, it is the price at which company or asset would change hand between a willing buyer and a willing seller, right? So on one side, there is a willing buyer, and the other side, there is a willing seller, right? Willing buyer, willing seller. So basically fair market value is the price at which company or asset would change hand between a willing buyer and a willing seller, right? That particular value, right? So neither is forced to buy or sell. No one is forced. You are not forced, right? Without any compulsion, neither any forcement. Both have all necessary information, that is reasonable knowledge, that buyer is also having information and seller is also having the information, and all the deal happen under normal market conditions. So these three conditions must be satisfied, right? So again I am repeating, it is a price at which a company or asset would change hand between willing buyer and willing seller. So think of it like selling a house. If both the buyer and seller agree on a price based on the market trend without pressure, that is the fair market value in action. So suppose you are buying a house with your counterparty, right, with another person, and both of you agreed on a certain price. So that price is called the fair market value of that house. So what is the company value made up of? So let's talk about this point, the company value. So when we value a company, we are not just looking at its profit. A company has multiple claims on its value. So let me write down, a company has multiple claims on its value, right? Just like pizza with different slices for different people, right? So you divide the pizza into different slices, and different slices is for different people. So similarly, company has multiple claims on its value. So you can see equity share. So when I say equity share, you can see the first part, that is the equity share. So equity share covers what? Equity share covers shareholder slice. This is a slice for the shareholder. Then the next slice is preference share. This is for investor with priority in getting paid. Then we have debenture. So these are the multiple claim. Debenture means money the company has borrowed, So borrowed money, and loans is obviously the borrowed money. So there are multiple claims on a company. The stakeholders, like different slices for different people. Equity share, there is a slice. Shareholders, the equity shareholders are obviously the shareholders. Preference share means investor with priority in getting paid. We talked about it in the previous lecture. Debentures are there. So all these claims are considered when determining the true value of company. It's not like that we can ignore these things. No, you have to consider the claims of all these things, right? Whenever we finding the true value of a company, we need to consider the claim of all these claims. Now there is something called IVS, which is International Valuation Standard. You know that, but wait, who decide how valuation should be done? Question is, who decides how valuation should be done? Who decides how valuation should be done? So now that we have understand basically what is the fair market value and what is the stake of the company, what are the claims that different stakeholder make, who are the stakeholder, so who decides the valuation of a company? So that is where International Valuation Standard, or in short we call it IVS, comes into picture. These global rules ensure that valuations are consistent. First point means no random calculation. Consistent means no random calculation. Then transparent. Transparent means that everything is clear. Everything is clear and fair. Third point is confidence. Confidence, or we call it trustworthy, which means investor and stakeholder can rely on the number. So these are the three important conditions: consistency, transparency, and trustworthy. Again I am repeating: consistency means no random calculation, transparency means everything is clear and fair, and confidence, trustworthy means investor and stakeholder can rely on the number. And according to this IVS 105, this is very important, right, which says that the right valuation approach must be chosen based on the type of company and the situation. So it means that valuation method changes with the different company and situation, right? That is the point. So this avoid overpricing or undervaluing asset. So to avoid this so-called overpricing or undervaluing, right, two things can happen: either the price can increase or it can be undervalued. To avoid this situation, what we do to avoid this situation, it says that right valuation approach must be chosen. Consideration must be given to pertinent and appropriate valuation approach. So it means right valuation method, it must be chosen. I hope this makes the sense to you, right? So final thought is that whatever we have discussed till now is that valuation is not just about number, it is about fairness, trust, global consistency. Whether you are an investor or banker, obviously banker you are, or CAIIB aspirant, understanding these key terms is crucial for making a smart financial decision, right? So I hope this makes sense to you. What is IVS, what is fair market value, right? Who are the stakeholders in a company, right? So that is the point. Now let's talk about what are the approaches to corporate valuation. Now that you have understand what valuation is all about, right? So we have talked about book value, market value, enterprise value, and we come to know that enterprise value is the most preferred way of valuation of a company because it takes into account everything, every aspect. Now let's talk about the different approaches to corporate valuation. So ever wondered how companies are priced? Why does one startup get sold for million and while others struggle to find a buyer? It all comes down to valuation approaches. So in this slide we will break down two major methods. The first is called market approach and the second is called income approach. So basically we are right now focusing on two methods. The first is called market method and the second method we are calling it income method. So let's talk about it. So friends, in the smartest way possible, first of all let's start with the market approach. What does market method says? So market approach says that, right, so let's talk about this so-called the market approach. So imagine you are buying a second-hand phone, right? You check price of similar model sold recently, right? So imagine you are buying a second-hand phone, you check prices of similar models sold recently. If a phone with the same spec and condition was sold for rupees 10,000 last week, you would not expect to pay 20,000 for it today, right? So you are buying a second-hand phone, you check prices of similar model recently. If a phone with same spec and condition was sold for rupees 10,000 last week, so you not expect to pay 20,000 for it today, right? That is exactly how market approach works in corporate valuation. Here is how. First of all, recent transaction. The key point is recent transaction. You know that what price have similar business been sold for? Comparable asset, which means how does this company compare in size, quality and performance? We are comparing company, so we will compare on the basis of size, we will compare the company on the basis of quality and performance, right? So these three things. Then industry standards. So you can see size, quality. So the third parameter we have is industry standard. Basically we are doing comparison, right? Which means what is the general market rate? It's all about comparison. The market approach help estimate a company worth by looking at what similar business have been valued at recently, right? So this is our corporate valuation method. Now this is the market approach. The second approach we have is the income approach. You know it. Now what if you are investing in a business, you would want to know how much money it will make in the future, right? So that is where the income approach comes into picture, right? So here is the logic. If a company is expected to generate a steady profit, suppose a company is expected to generate a steady profit, right? Its value today will be higher, obviously higher value, right? But if the future earnings are uncertain, its value drop. So the formula is simple. This is something called net operating income, NOI. So NOI divided by capitalization rate. NOI divided by capitalization rate. This will give you the present value. So in short, income approach tells us how much is the company worth today based on what it will earn tomorrow. So both these methods, whether market approach or income approach, help investor, banker and regulator put a fair price tag on its business, right? So if you want to master CAIIB concept easily, hit that subscribe button and stay tuned for more simplified explanation. Now let's talk about the cost approach. So I hope this is clear now, how to find this and how to apply this income approach. You can see NOI divided by capitalization rate. Let's talk about the cost approach. So friends, what is cost approach all about? Ever wondered how much a business is worth if you break it down to its core asset? What if a company is struggling or hold valuable property? That is where the cost approach comes in. Today we will simplify the asset based valuation method in the way that make perfect sense. This is also known as asset based approach. Either you call it cost approach or you call it asset based approach. Both means the same. Imagine you own a house. If you wanted to determine its value, you could check the land price and the cost of rebuilding the structure. That is exactly how the cost approach works for business. It simply asks, if we had to rebuild this company from scratch, how much would it cost? If we had to rebuild the company from scratch, how much it would cost? So the approach look at the fair market value of all the asset. It look at the fair market value. I think we know it, fair market value, what it is. I've just given you the example earlier, right? Fair market value. It look at the, again I'm reminding you, because reminding more and more is very much important. Let me remind you what fair market value is all about. So I told you that fair market value is the price at which company or asset would change hand between willing buyer and willing seller. Means under no compulsion you are making, you are buyer, you are selling something, the price which will be there, this is called fair market value, right? So under no compulsion, there is no compulsion is there. So basically in this cost approach or this asset based approach, what we are doing, we find the fair market value of all the asset a company on. So what are the assets that the company own? This may include, this may include building. This may include building, first point. This may include, machinery. This may include land. It may include inventory or cash, all these things. So, and add all these up, subtract liability, and boom, you have the company estimated worth. Because asset minus liability, right? These are the asset and you have to subtract the liability. So you will get the company total value. So when is the cost approach used? So this method is based for asset intensive business, means like real estate company or manufacturing firms. Then it is good for holding corporation, which means investment in other business, holding company with investment in other business. Troubled entity means a struggling business where assets are worth more than company's profit. The two key concept, build versus replace. Right, there are two key concept here. So now there are two way to calculate value here. The first way is to see the cost to build. We call it cost to build, which means what would it cost to create the exact same company from the ground up. And the second is cost to replace, which means that what would it cost, how much would it cost to replace all the asset with modern alternative. So both method, either you cost to build or cost to replace, both method help assess how much a company is worth based on what it owns, not what it earns. So final thought is that this cost approach is just one way to value a business. Sometimes it is the best method and sometimes it is not. Choosing the right valuation method depends on the situation, right? So I hope I have done justice to your preparation, that I have told you that basically when to use this cost approach, right? Two conditions I have told you. right? Just now you want to evaluate a project, right? You want to evaluate a project. This is for asset, which is asset heavy business, holding corporation, troubled entity. For this is the business act like the best. And you know how we do it. So cost to build, cost to replace, that is how it works. And it is, and we find the fair market value of all the asset involved, right? Building, everything we have talked about. Now let's talk about the criteria for selection process, right? Very, very important point. So friends, ever wondered how experts decide the best way to value a company? Should they check asset value, compare similar business, or focus on future profit? So I've told you these three things. Income approach is all about the future profit. Market approach is all about the comparison. And cost approach, just now we have talked about, it's all about the asset value, right? These three methods we have just known. So today we will break it down in simple terms so that you can master the concept. So the step one is understanding the basis of valuation, right? So the first step is you have to understand the basis of valuation. You know that before choosing a method, we must first answer why we are valuing the company. Why we are valuing? We must answer this question. Why we are valuing? Is it for selling the company? Is it for merging with other business? I told you, business undergo with this valuation for selling. Either they want to sell, they want to know the value, they want to merge and acquire the other company, or it is for regulation or taxation purpose. The purpose of valuation decide the best approach to use, right? So this is the point, basis and premise of value. That means what is the purpose of valuation? Either we are, do we want to do merger and M&A? Do we want to engage in this? Do we want to regulatory or taxation purpose, or do we want to sell the company? So first of all, you have to decide the purpose. Now, each valuation has its own strength and weakness. Let's talk about that. You know, there are advantages and disadvantages of every method. Like if you talk about the market approach, you know, great when you have recent comparable sales data, but not useful for unique business. Obviously, if you have comparable business, you can compare with them. This is great for such business. We have recent data you have. But if it is unique business, this not be ideal. So this market approach, you know, it is not great for unique business. This you have to remember. And if you talk about the income approach, where you calculate the present value or future value, you see the future value of this company, on basis of that you decide. So it is based when a company has a stable earning. Yes, very good. If a company has a stable earning, then it is based. But tricky if future income is unpredictable. When you can't predict the future income, how will you say the income approach? And this cost approach, you know, it works well for asset heavy business. When you find the asset, you can find which asset is made up of, but ignore potential future profit. Right. So the smart valuer always weigh the advantage and disadvantage before choosing a method. So this is called advantage and disadvantage. The third key point is appropriateness, which means, you know, that choosing the right method. Selecting a valuation depends on the type of asset. You see the nature of the asset. This is the first point, which means, you know, is it business, property, or investment? Obviously, this you have to decide what kind of asset is it. Is it business, property, or an investment? Then the third thing is, what is industry practice? What are the method utilized by market player? Means what is the industry practice, right? Industry practice, this also plays an important role. Means what do market experts usually follow? And the last is importance of each method, means availability of reliable data. If there is no solid data, the method won't work. Now when to use, question is when to use multiple method, right? You know that sometimes using just one method is not enough. If data is limited, combining approach give a measure accurate picture, right? So here the point is when to use multiple method, right? So sometimes using just one method is not enough. Data, suppose we have limited data. So this define, suppose we have data is limited. If data is limited, you know that if data is limited, combining approach gives a more accurate picture. So we will combine the approach. Two approach we will combine, right? Combine approach. And you know, but remember, valuer don't just average the result. They carefully compare and reconcile the number to reach a final conclusion, right? So what is the key to corporate valuation? You choose the right approach based on the situation, right? A good valuer adapt and make informed decision, right? So I hope this makes sense to you, that criteria for selection process. You look at the, so what are the 4 points which you have covered? First of all, you should see the basis of valuation, whether for selling a company, merger, acquisition. You should see the pros and cons of each methods. You should go through the right method, choosing the right methods, and when to use multiple methods, this you have to decide. Now let's talk about the consideration of the multiple method, right? So friends, just now we are saying, so if a valuer has high confidence in a single method accuracy and reliability, they are not required to use multiple methods. This is especially pertinent in property valuation, right? However, multiple approach and methods would be considered, particularly when insufficient input exists. That is what we have talked, right? Now primary valuation method. So these are the primary valuation method. The first is called adjusted book value, stock and debt approach, direct comparison method, and discounted cash flow method. So these are the four methods. So first of all, let's get started with the adjusted book value, right? So it relies solely on the company balance sheet data. It is least complicated method for determining a company value, right? So what we do, we direct tally of the book value for of investor claim. We determine the total value of company asset minus non-investor claim. So let me give you an example, right? So here is your balance sheet. So using this balance sheet, we can understand it properly, that how this adjusted book, so we are talking about the adjusted book value, right, method. So how does it work? So here look, here you can see. So friends, this image shows the balance sheet of an abstract limited. This is an abstract limited balance sheet is shown on 31st March 2022, and it includes, so right, a balance sheet, you know, is it is just like a financial snapshot of a company, showing it asset, showing it liability, right? So when I say asset means what it on, and liability means what it owes. Simple word. So asset means what it on, and liability means what it owes, right? And you know, equity, there is some part equity also. What is equity? Equity is the money shareholder have, means shareholder have how much money. This is called equity, right? So in this case, you can see total asset. If you add the asset, see, these are some component. Fixed asset, right? This is a fixed asset. Gross block, accumulated depreciation, right? So these are the fixed asset part, net. And we know this investment, current asset, receivable, inventory, prepaid expense, all add all of them, you will get 116.40. There are some current asset, non-current asset, everything is included here, right? And this is in crore, data is in crore, you can see, right? And total liability and equity, so these two are part of equity. And the reserves and surplus, secured loan, term loan, NCD, unsecured loan, bank overdraft, intercorporate loan, current liability, right? So total adds up to 116.40. So this balance is expected because of the accounting equation. What is the accounting equation says? The accounting equation says that asset is equal to liability plus equity, right? You add this 45, right? And you add this so you add all of them, these two will be equal, right? So if you break down, if you see the breakdown of asset, so asset, what the company on, fixed asset is how much? 63 crore, like property and equipment. Then we have investment. You see investment you have 11.50 crore with stock, bond, etc. Current asset, you know, cash, bank balance, receivable, inventory, right? You add all of them. And what about the prepaid expense? Yes, you add all of them, you will get 41.90, right? And fixed asset includes these two, gross block minus depreciation. Similarly, share capital includes equity. Similarly, debentures and unsecured loan, here you can see, you just come on the left side, you will see debentures, unsecured, here you can see unsecured loan, term loan is there, right? Secured loan means how much? 24.30 crore, means backed by collateral. Term loan, you know, long term bank borrowing. Non-convertible debenture, other borrowing, bank overdraft, right? Current liability and provision, you can see here, means short term due, bill payable. And finally we have equity and reserve, this part, share capital. So two valuation method we have, right? The first is called investor claim approach. You can see on left side you will see investor claim approach, and on right side you have see asset and liability approach. So investor claim approach means who has a claim on the company, right? I told you earlier also, who are stakeholder, who have claim on the company. I told you that one claim is for share capital, reserves and surplus, secured loan, unsecured loan. So this approach calculate what remain for investor after paying the debts. So you can see share capital is how much? 47 crore. Reserves and surplus is how much? 21.20 crore. Unsecured loan is how much? Unsecured loan 6.50. Secured loan is how much? 24.30 crore. Means those who have invested, what remains for them after paying the debt? The company has paid all kind of debt it has taken. What remain after is called the investor claim, right? Those who have invested. So share capital, reserves and surplus, and secured loan, because they have taken loan, this is remaining, an unsecured loan. This term loan, these non-convertible debenture, they are not taken into consideration, right? 24.30, just you have put the value here, right? And if you look at this asset and liability approach, in this case, what is the company net worth? What it does, it subtract total asset minus current liability and provision. So what is the total asset? It is 116.40. What is current liability and provision? It is nothing but 19.40. So this gives us 97.00. So both way you can calculate it. Either you do the investor claim approach, right? So both method arrive at 97 crore, proving that valuation technique are interconnected. So investor and creditor focus on different aspect, but the core value remain the same, right? So subtract assets and liability, total asset minus current liability and provision. This you are not to consider. This is what you give the valuation of a project. And also we can see who are stakeholder in the company. Those who have given secured loan, those who have given unsecured loan, right? Right. So this much loan it has taken. So these are the stakeholder claim, investor claim, share and their reserves and surplus are there, right? So that is the point. Now let's discuss what are the factors affecting precision of book value adjustment. So basically, which method we have talked about just now? The method we have talked about is called the book value approach, adjusted book value approach, right? So that is what we have done. We determine the total value of company asset minus non-investor claim, that is account payable, right? So use the balance sheet of abstracted limited to compute company value through both approaches. Two approach I told you: direct tally of book value of investor claim and determining the total value of company asset minus non-investor claim, that is account payable, right? So let's talk about the factors affecting precision of book value. Let's talk about it now. So friends, we are talking about book value approach and valuation, but wait, is book value really accurate or does it need some fine tuning? So book value is simply the value of company asset as per this balance sheet. Seems easy, but here is the catch: book value might not show the true worth of a company, right? You must remember that it might not show the true value of a company. Why it might not show the true value of company? Let me write down. Book value is not the true value of a company. Why so? Because because of these three factors. The first factor is the inflation. You know that the silent killer of value. So imagine you bought a house 20 years ago for rupees 10 lakh, right? Today that same house is worth 1 crore, right? Today that same house is worth rupees 1 crore, but on paper or the balance sheet it is still sold rupees 10 lakh. That is the problem with the book value. It does not consider inflation, right? Because on the paper it is still 10 lakh, but it ignores the inflation. Second is the technological advancement, which means technology move faster than depreciation. Think about mobile phone. A brand new phone become outdated in just 2 to 3 years. Now imagine a company that own machinery worth rupees 10 crore. A company that own a machinery worth rupees 10 crore. By the time it is fully depreciated, it may already be obsolete. So book value fail to reflect the technological advancement. And the third thing is that people and relationship. What about the organization capital? What about the people? What about the relationship? That a company is not just about machine and building. It's also about people, customer, supplier. This is called organization capital. You know about HRM. This is all about it. So the unseen value created by strong relationship, customer trust, and brand loyalty. Sadly, book value does not capture all this. So to get a more accurate picture, more accurate value, we change the book value by considering the replacement cost, right? So we are modifying the book value by considering the replacement cost, right? This is very important thing. So how we do it? First of all, we see the cash and cash equivalent, this component, cash and cash equivalent. What does it mean? So no change is needed because cash is always cash. So we do not replace it, right? We do not to factor it anymore because cash is always cash. What about the receivable? You know what is the meaning of receivable? See, there are two things, payable and receivable. Means sometimes what happen, we give someone some item. Suppose we are service company or suppose we are product company. We have a product, so we give the product in advance and we'll get the collection letter. We will get the payment letter. So that is called receivable. So we check for possible bad debt and adjust accordingly, right? So you should make the provisioning for default. That is the point. And if we talk about the inventory or stock in hand, so this need a special treatment. For raw material, what we do, it is valued at the latest purchase cost, means recent acquisition cost, means what was the latest cost at which it was purchased. So that is how we have to factor it. Work in progress means WIP, which means either a total cost or estimated selling price minus future expense, right? That is called WIP. And for finished goods, that future cost are deducted from the sales price. So the final takeaway is that book value is just the starting point, not the final word on valuation. Inflation, technology, and intangible distort the real picture, and adjusting book value for replacement cost give a better estimate of the actual worth, right? So I hope this makes sense to you regarding the book value approach. right? Then we have some other current asset. What is the meaning of other current asset? So friends, today in this slide we are talking about how different assets are valued in financial statement, but here is the twist: not all assets are created equal. So this is the key point. You must note it down, that not all assets are not all assets are created equal, right? So some stay constant, some lose value, and other depend on the market trend, right? So first of all, let's talk about other asset, the straightforward one. Let's start with the easy to value asset. The first is the deposit. Deposit, just like your fixed deposit in the bank, they are recorded at their book value, which is the original amount. So either we call it book value or we call the original amount, right? That is called deposits. The next we have prepaid expense. What is the meaning of prepaid expense? So what is the meaning of this prepaid expense? That imagine paying rent for a full year in advance. It is recorded at the amount you paid. No adjustment is required. So in this case, we do not require any adjustment. So like you have FD, these are recorded at the book value, which is the original amount, right? What was the original amount of the FD? That is the point. Prepaid expense means what? Means some expense you have already paid. So you pay rent for a full year in advance. So it is recorded at the amount you paid. No adjustment is required. And also accruals. What is the meaning of accruals? Which means that the amount the company has earned or need to pay but has not received and settled yet. Means some amount company has earned or company has to pay, but it has not been settled yet, not has been received or settled yet. Again, they are valued as per the book. So moral of the story is that these assets don't need complex valuation method. They are just taken as they are. Remember the name: deposits, prepaid expense, and accruals. These are just taken as they are. No need to use complex valuation method. Then we have something called tangible fixed asset, the physical one. Now come the interesting part. Big asset like land, building, machinery, they need proper valuation. Land never depreciate. This is the evergreen asset. It never depreciate, but its value depends on the market demand. Yes, its value, land value, depends on the market demand. So when valuing land, we assume that it is vacant and available for sale. No extra calculation. Suppose we have building and civil works. That building lose value over the time due to wear and tear, right? So we use replacement cost minus depreciation to find their true worth. So we should depreciate, we should subtract the depreciation and deterioration, right, from the replacement cost, right? Then we have machinery and plant. Again, machinery is not just about purchase price. It includes, machinery includes market value of a similar machine, transportation cost, right, installation cost. So final value will be sum of all these: market price plus transport plus installation. So because machinery can be expensive to move and set up, so ignoring these costs can undervalue the asset. So these are things, right? So about it, tangible fixed assets, how do we value it? Now if we talk about the intangible fixed asset, right, some of the most valuable assets are not physical. They exist in ideas, right, and license. For example, patent, software, and copyright, these are called intangible. You can't touch them, they are ideas. So these are valued based on multiple factors, like their book value, means original cost, market price, if they can be resold, utility, which means how useful they are, and remaining life, means how long they will be valuable, and their license and a spectrum. Telecom industry, if you have ever wondered why telecom company pay crore for a spectrum license, here is the reason: they are super valuable and limited in supply. So their valuation is based on a special criteria set by the regulatory body, that is called a spectrum allocation. So final takeaway is that some assets stay constant, like deposit, prepaid expense, and accrual. Some tangible asset need adjustment for depreciation and setup cost. An intangible asset depends on utility, lifespan, and market demand. So understanding how assets are valued is very crucial for CAIIB examination. Then we have something called non-operating asset. What about this non-operating asset? How their valuation is done? So what happened to asset that a company does not actively use in operation, and how do we value a company if it's shutting down? So friends, what is non-operating asset? Means the extras on the balance sheet. These are the asset a company owns but does not use it in daily business. Think of it as financial side gigs. So that financial security. So this is called market driven asset. This include investment like stocks, right, bonds, mutual funds. So their value is simple: they are worth whatever the market is willing to pay. Then we have surplus land. So extra real estate. Some company own land that did not use, maybe for future expansion or just as investment. So they are based on the current market price, just like selling your house. Then you have some disused structure, which means imagine an old factory that a company no longer uses. It still has value, but only at its market price, not at original cost. So the key takeaway is that non-operating assets are valuable, but their worth depend entirely on what the market is willing to pay today. So it's completely about the present market value. While in the first case we have seen tangible thing, we have seen that they were current original price, right? That is the point. Now liquidation value. What if the company shut down? So now let's talk about what happens if the company goes out of the business and need to sell everything. So there is something called liquidation value, right? So question is, why is liquidation value so important? Question is, why is this liquidation value so important? Liquidation value we are talking about. So it tells us how much money the company can recover if it sell all its asset. If we talk about the liquidation value, how much amount the company can recover by selling all asset, right? This is often lower than the book value because assets may not sell for their original purchase price. Book value is the original purchase price. When you talk about this book value, this is the purchase price, and this liquidation value, this LV, is always less than BV, book value. Why? Reason being that because assets may not sell for their original purchase price. And there is a role of here secondary market here. What is the role of it? That if an asset has a strong resale market, its liquidation value is close to the secondary market price. So suppose an asset has a strong resale market. Some asset have a resale market where you can resell the product, like some vehicles, house. So liquidation value is close to the secondary market price. For example, a second-hand car dealership can easily sell used car at market rate. What about asset with no secondary market? So suppose an asset has no secondary market. Some assets are hard to sell, like custom built machinery. Here appraiser estimate a price, but it's not always accurate. So they have certain disadvantage, lack of secondary market, right? So what liquidation value ignores, right? Liquidation value, it does not consider organization capital, which means brand reputation, customer loyalty, right, and employee expertise. Instead, it treats the company as a collection of assets rather than business that generate income. So it treats the company as a collection of assets, not just the business entity. So where is liquidation value used? So we know about liquidation asset, where it is used. So application of it, that it is relevant for company that are worth more when sold in parts rather than as running business, right? For example, a falling airline. A falling airline is the best example of it, right? Because it might sell its plane separately instead of trying to keep the airline running. So basically those companies that is worth more when sold in parts, right? Then we have something called adjusted book value approach, also called replacement cost or liquidation value approach. It is useful for companies that rely heavily on tangible assets like factory, land and equipment. So what is the final takeaway? That most business are not valued this way because the real worth lies in brand reputation, employee and customer trust. Think you can put a price tag on. So non-operating asset means extra investment, unused land, building are valued at the market price. Just now we have talked about. Then liquidation value tells us how much a company asset are worth if it's shut down. It ignores brand value, customer loyalty, workforce skill, and this method is rare except in a specific case like falling business, right, where the liquidation value is used, right? Now let's come to our next approach, which is stock and debt approach. So friends, sounds complicated, not anymore. By the end of this slide, you will know exactly how company are valued using this method. Imagine you want to know how much a company is worth today. One way to do this is by adding all the value of everything investor on, right? So whatever investor has on, you add everything up. It's shares and debt. So what investor will own? Obviously shares they will own. They will give some debt, right? So you add all of them. This will give you the investor value, right? This will give you the total value, right? How much company is worth today. So step one is finding the market value of equity, right? So what you do, you find the market value of equity. This is, you can see, market value of equity means which we call share, market value of share we call it. So a company stock price tells us what investors are willing to pay per share. Multiply this by number of share and you will get the market value of equity. Because suppose one share costs rupees 50 and outstanding share is 15 lakh. So 15 multiplied by 50 is how much? This will give you 7.50 crore. So this will give you the market value of equity. Then you find the market value of debt. How to find the market value of debt? Because I told you now that this consider the stock and debt approach, consider that you want to know how the company is worth today. So one way to do is to add up all the value of everything the investor on two things, either share or equity or debt, right? So they own these two things: share, debt, equity, or debt, right? Share or equity we call it, or debt we call it. So if we talk about the debt portion, how to find the market value? So company borrow money through bond and loan. If you talk about the debt, so there is bond, there is loan, through which company borrow money. These debt also have some market price, right? So through bond and loan, company borrow money, right? And these debt also have their market price, which may be different from the original borrowed amount. So you add all of them. So you see this market value is given 14.80 crore, market value of equity is given 7.50 crore. You all add all of them, then this will give you market value of equity, this we call MBE, plus MBD, market value of debt. Add all of them, this will give you the total value, which is nothing but 22.30 crore. So this gives us a snapshot of how much the company is worth in the eye of the market. So one real life example is given in your book. This is regarding the share. So you can see C-Sore Limited on March, right? Share is 15 lakh, right? Market price per share is 50 rupees per share. So total market value you have calculated, total market value of debt you have calculated, total company value. But the controversy is that market price versus average price, what to use? So there is market price, there is average price. So stock price keeps changing, right? Today it is rupees 50, right? Tomorrow it could be 55, or tomorrow it could be 45. So should we choose the latest price or an average of the recent price? So the rule is that the rule is quite simple, that if the market is efficient, right, meaning the price reflect real value, the latest price is good enough, right? So there no need to averaging price. And if the price are volatile, some experts suggest to taking average to smooth out the fluctuation. So the debate continue in the finance world. This debate is continuing in the finance world. If the market is efficient, which means price reflect the real value, then you should not do averaging it, right? You should choose the current market price for stocks. So what we learned from this discussion is that a stock and debt approach is equal to market value of share plus market value of debt. It gives a real time estimate of the company worth. It works best when market are efficient. A stock price volatility can create challenges. Then we have something called direct comparison approach. What it says, let's try to understand. That ever wondered how experts figure out the right price for a company or property? Why would one company be valued at 100 crore while other similar one is worth 80 crore only? The answer lies in a method called direct comparison approach, where we compare similar business or property to determine the right value. So friends, imagine you are buying a smartphone, right? So you find two models with the same feature. One costs rupees 50,000, other costs rupees 40,000. So of course, which one would you choose? Of course, the cheaper one, that is 40,000, right? This is exactly how the direct comparison approach works. Buyer won't pay more for a company or property if the similar one is available for less. This is called principle of substitution. If a similar company is available for less, why would buyer pay more, right? So valuation expert compare recent sale of similar business to estimate the correct price. So recent sale of similar business, this is called direct comparison approach. So what are the key steps? The key step is that first find the best use of property or business, right? Determine the property or business highest use. What is it not profitable for? Can it be used differently to make more money? A piece of land is, for example, a piece of land in a prime city location could be used for housing, it could be used for offices, it could be used for shopping mall, because it is a prime city location. So the best use determines its value. Second thing is you should identify similar comparable property, which means find business or property with the same highest and best use. So you should look for the actual sales record. Of the similar company or property. Choose comparison from the same industry or location to get accurate result. And then you should adjust for the timing, which means a property sold 5 years ago might not have the same value today. So valuation expert adjusts the price based on market trend. So that is called timing. That a property sold 5 years ago might not have the same value today. So valuation expert adjusts the price based on market trend over the time. And you should make other adjustment also, which means some property or business have better amenity, newer equipment, strong brand. These affect the value. So adjustment are made for location, age, condition, legal factor, everything. So you should choose the best comparison, which means the best comparison are those that require the least amount of adjustment. The fewer the difference, the more reliable the comparison. There is something called conversion used, correct unit conversion, which means that if one business is valued per square foot and other per square meter, the number won't match, right? Suppose one business is valued per square foot and other business is valued per square meter. So in this case the number will not be matching. So expert ensure that right unit conversion for precision. Let's say you are valuing a hotel. Let me give you an example to make it more clear. Let's say you are valuing a hotel. You find two recently sold hotel in the same city. Hotel number A sold for 100 crore. It is a 5-star luxury hotel. And hotel number B, it is sold for 70 crore. Right, it is a mid-range 4-star hotel. Now if the hotel you are valuing is 4.5 star, so you would adjust it somewhere between 70 to 100 crore, right, based on facilities, location and financial. So the final takeaway is that buyer won't pay more than necessary. This is comparison is the key. The best comparison is one that requires the least adjustment. Timing adjustment, unit conversion, and ensure accurate valuation. And this approach works best when recent comparable sales are available. Now, what are the key steps in direct comparison approach? Let's look at the key steps. I think we have discussed it. So imagine you are trying to price a house. So you find two similar houses in the same area, one sold for 1 crore, other for 1.2 crore. But wait, the second house have a bigger garden, extra parking space. So is it fair to compare both at the face value? Not really. That is exactly how business valuation work too. When comparing company, we need to adjust for difference to make fair estimate. So how to adjust the comparable value? So the first, while valuing a company, we compare it with other that are similar, but no two business are exactly the same. So we make adjustment for key factor like size of the business. We make some adjustment like what is the size of the business. Bigger company may have higher valuation. We look at the location and facility. A prime location add more value. Growth potential. A company with higher growth potential prospect have higher valuation. So first thing we look at the business size and shape, right? Which means just like a 5-bedroom villa cost more than 2-bedroom flat. A big company with a strong operational command a premium, right? Then we look at the growth and future potential, right? So we look at some growth and future potential. So this is the point, higher growth rate, right? So a company expected to grow rapidly will trade at higher valuation. For example, a startup with huge future earning may be valued more than an old slow growing company. So we use some multiple for adjustment. So this adjustment can be done by using some multiple, right? So what are the multiples, right? So I like P by E, price by earning ratio. This help adjust value. So company with high growth rate often have higher P/E multiple. For example, let's say company A, it has P/E of 15. Let's say P/E value is 15. So expected growth is 10%. Company B, it has P/E of 10, right? So expected growth is 5%. So company A has higher earning multiple because it is expected to grow faster. So that is why this multiple is higher for company A. And there is something called a statistical adjustment. Means analysts use regression method. So multiple regression is used to adjust value mathematically. So let me give you some real world example to make this concept more clear. Let's say we are valuing an IT company, right? So we find two similar firms because we are talking about DCF only, the direct comparison method. So we find two firms. Company X, it is valued at 500 crore, right, but is growing at 5% per year, 5% growth, annual growth it is. And company Y, it is valued at 600 crore and it is growing at 10% per year, 10% growth is there. So even if their current earning are same, company Y has high valuation due to better growth potential. So to compare fairly, we must adjust company X valuation upward or company Y valuation downward based on their difference. So what is the final takeaway from this discussion is that valuation is not just about comparing number, it is about adjusting for difference. So whatever difference is there, we should adjust it, right? So there is some multiple which is used for adjusting. Just now we have taken one example like P/E ratio. So bigger, better located and higher growth company often trade at premium. Using price earning growth ratio help make fair comparison. A statistical model help remove bias in valuation, right? So friends, this is all about our part 1 lecture. So I have told you every basic ideas. I have given you the basic ideas about this valuation. So we have seen a stock and depth approach. We have seen the adjusted market value approach, right? Book value approach. What is book value approach all about? So we have talked about all this part right now. So in the next lecture